Welcome everyone to Crypto DeFined. My name is Kathy Chu. I'm a former Wall Street Journal and USA Today reporter. I'm your host for this news interview series where we look at the skeptics, the innovators, and the disruptors of the $1 trillion crypto industry. Crypto DeFined is produced by TruthDAO, a new nonpartisan journalism organization within a DAO. You can visit us at truthdao.xyz, join our Twitter and Discord communities for more information. Today's guest, we have the pleasure of talking to Frances Coppola. She is a well-known figure on Twitter and especially on crypto Twitter. Frances is an analyst, a commentator, and an economist based in the UK who has closely followed the meltdowns of the crypto lenders and who offers up in-depth comments and analysis on her blog, CoppolaComment.com. Her book, The Case for People's Quantitative Easing, makes the argument for quantitative easing where money doesn't go to the financial markets and big banks, but rather goes directly to ordinary people and small businesses. Thank you, Frances, for being here with us today. We greatly appreciate it.
A pleasure.
So, Frances, for those of you who don't know you, can you briefly tell me your general views on the crypto industry? Where do you stand in terms of the spectrum of whether you're a skeptic, a supporter, somewhere in between, or no, none of the above? It helps people in the audience to understand where you're coming from.
I guess I'm pretty skeptical, really. I always have been. When Bitcoin first started, I quite liked it as a payment mechanism. I could see what Satoshi was trying to do, read the white paper, and I was interested in what it was doing. And early on, you could buy Bitcoins for like pennies. And we were just sending Bitcoins around the place and using them to, I guess, move value much faster than the traditional financial system could. But as time's gone on, Bitcoin has changed from that fast, cheap, flexible, secure payments mechanism that looked as if it could threaten the mainstream into really now a speculative asset. We discovered in, I think, about 2014, 2015, that it actually didn't scale up very well. So once it was handling much larger volumes of transactions, it tended to grind to a halt. And I know there have been attempts since to find solutions to that, to the Lightning Network, but they're not without their problems. And I think the solution that the crypto world has come up with since really has been to say Bitcoin is like gold, Bitcoin is an asset, Bitcoin perhaps could underpin a financial system, and it could be a reserve asset, something like that, but that a payments mechanism needs something more liquid. And the crypto industry has come up with stablecoins, which are also not without their problems, not least among which is the fact that they are pegged to the US dollar. I would have expected really that the crypto industry might have used Bitcoin as the foundation of its liquidity. So rather than pegging stablecoins to the dollar, might have thought they would have been pegged to Bitcoin, but that's not how it's played out. How it's played out is we've ended up with a whole ecosystem that really depends on the US dollar, and that is a world away from what Bitcoin was meant to be originally, when Bitcoin was meant to replace the existing system. As the present crypto ecosystem seems to have tied itself to the existing financial system and increasingly becoming interconnected with it. And that's a source of quite considerable concern for me.
That's very interesting, Frances. And I want to talk to you about stablecoins in a little bit, but let's talk first about the overall crash of crypto assets. It's been a rocky year, to say the least, for the crypto world. Crypto's market cap is now, I think it's 900 and something billion. That compares to about 3 trillion less than a year ago. So that it's 1/3 of what it was a year ago. As you pointed out in one of your articles, Frances, crypto prices have plunged a number of times before. For instance, after a Mt. Gox collapse in 2014, then after the ICO craze in 2018. Each time, though, prices have not only recovered, but soared much higher a few years later. You think, though, that things are different this time around and that it may be harder for crypto prices to rise as much as before. Now, why is that?
The reason is because we are coming into a different monetary paradigm. Bitcoin was created after the financial crisis, when we entered into this extraordinary era of very low interest rates and quantitative easing. And we've never really got out of that. So even though in 2018, the Fed raised interest rates and partially unwound its balance sheet, other central banks were doing QE at that time. So at the same time, the ECB actually had negative interest rates and was doing QE. In fact, the ECB started doing QE just as the Fed stopped doing it. So it was almost like a relay race. It was the baton of QE being handed on to other central banks. As one central bank stepped out of the race, another one took over. And that's been going on really ever since 2008 until now. Now, for the first time in the whole of crypto's history, central banks are embarking on concurrent monetary tightening. We've never seen that before in the crypto world. And that's why I think this time is different. That in a way, because the crypto world has become very dependent upon fiat currency liquidity, really. And there is a brutal drain of fiat currency liquidity going on in traditional markets. And that ricochets out into crypto markets as well. And try as they might, crypto markets can't create dollars. The things that create dollars are the Fed and commercial banks, traditional finance. They create dollars. Crypto markets don't. So when the Fed is withdrawing dollars at a rate of knots and commercial banks are withdrawing them as well, then it's hard to see where the dollar liquidity for crypto markets is going to come from. And although stable coins can maybe try and create what looks like dollar liquidity, in the end, they've got to have the reserves to back that. They're being dumped on by regulators who say they've got to have the reserves to back the quasi dollars that they create. And increasingly, it's getting harder and more expensive for them to raise those funds. So
so go ahead.
So that's, I think, why this time is different, that for the first time it's in the entire history, the crypto world is having to deal with a shortage of dollar, I say dollar, but fiat currency liquidity. And they've never seen that before. The whole of crypto really has been a QE play. And that's now being withdrawn. So I would expect that there will be further falls in crypto markets as long as this tightening phase goes on.
Right. And as you mentioned in one of your pieces, we're nowhere near the bottom yet, you believe, partly because institutions see crypto as a high-risk asset, so it's first in line to be dumped when the cost of funding rises. Is that correct, Frances? And does this thinking also apply to retail as well? Since so much of the crypto industry is driven by retail, that's not true necessarily in the traditional equity markets, but crypto is really driven quite a bit by retail and increasingly institutions, but both of the two.
Yeah. I think we've had a long period of what we might call reach for yield, where interest rates have been on the floor in traditional markets. Nobody can make any money on their cash, right? People who have invested in other assets have seen asset prices rise. So if you've been involved in the stock market, you've seen the value of your stocks rise. But if you're holding any kind of liquid asset, cash, bank accounts, anything like that, then you're making nothing. And for a long, long time, and that's been for like over a decade, people have not been making anything on their cash savings. So it's not surprising that retail investors have looked for places where they can put their money, which will be reasonably liquid, where they can just manage it themselves rather than having to put their funds into the hands of a managed fund or something like that, and which will earn them some interest. And that's been a lot of the driver of the retail inflows into crypto, has been because it's relatively easy, really, for a retail investor simply to put a relatively small amount of money into crypto markets, and a whole forest of companies and apps and platforms have grown up to help retail investors do that. Some of those platforms have now failed, because actually what they were doing with retail investors' funds was extremely risky and it didn't work out. And some of them have turned out to be not entirely honest either. And that's always a risk with unregulated markets. But the underlying principle is that when retail investors can't get any interest on their savings, they look for, within the conventional, traditional banking system, they look outside it to find places where they can put their money to be reasonably safe and earn them more interest than they can get in traditional finance. And that's what's been driving a lot of the retail investment in crypto really for quite a long time now.
Now, Bitcoin has been pitched and has been seen traditionally as a hedge against inflation. Is that no longer the case anymore because of, partly, as you mentioned, there's this dependency in the crypto world to fiat currency? So, is Bitcoin still seen as a hedge, or is that argument dead?
I think it depends on your time frame. If you look at Bitcoin over its entire history, then Bitcoin has persistently risen. It's been a bit like property in that respect, that on a long enough time horizon, you're looking at an asset that appreciates. And so from that point of view, given that fiat currencies are designed to depreciate over the long term, that's what the 2% targets pursued by central banks mean. You could say that Bitcoin in that respect is a hedge against inflation, but it's on that very long-term basis. On the short term, on a much shorter horizon, it clearly isn't, because it's much more volatile than any fiat currency. During its, if it were a fiat currency, if it were a currency, during its lifetime, we would have seen 4 episodes of hyperinflation. I mean, that no fiat currency has that kind of record. No,
Right.
So from that point of view, it's a very poor hedge against inflation in the short term. The dilemma now is whether, given we are in our 4th phase of hyperinflation, whether it's going to recover from that, how long it's going to take it, and whether it will go back to its previous long-term growth trend. We don't know that. I know a lot of people think that it will. They say, yeah, we've seen crashes before. Every time it's rebounded and it's come back to the growth trend before, and it's carried on rising, right? My argument is that because this time is different, because we've come into a monetary tightening cycle that we haven't seen in the whole of crypto's history, it's possible that Bitcoin might not come back to its previous growth trend.
That's very, very interesting. I know that you see divided reactions on Twitter about, Bitcoin's about to rise again, or it's due for another fall. But that's an interesting thought, that even if it recovers, or even when it recovers, it's not going to reach the heights of yesteryears. So let's talk a little bit about these crypto lenders. You mentioned that there's been some retail investment into the crypto industry as people chase these yields. Some of these yields, up to 20%, I think I've seen much higher even than 20%, have come from these lending companies in the crypto industry, which basically ask investors to put their money with the lenders, and then the crypto lenders take that money and put it in other DeFi products. So some of these lenders, as you've mentioned, are now bankrupt. And I know you've been following these cases closely. I remember on your Twitter feed, You even mentioned you read all 1,000, I think it was 1,157 pages of the court filing against crypto hedge fund 3AC, which is not something that everyone has done, Frances. So from your perspective, that's very admirable that you read every page. Now, from your perspective, entrenched in this industry, do you think any of these firms, Frances, will be able to revive themselves and, more importantly, gain investors' confidence? Assuming they should have investors' confidence, that's a key. If what are your thoughts on that?
There's a lot of interconnectedness here. So you look at one firm and you discover it's connected to other firms which are also in a mess. So, for example, Voyager, we talk about that one, was essentially bankrupted by a single loan to 3AC, the hedge fund 3 Arrows Capital. And its ability to resurrect itself rather depends on whether it can recover that loan from 3 Arrows Capital. My view is it probably can't. But you can see we're going to see a lot of lawsuits. This is going to take a very long time to sort all of this out because it's all so interconnected and there's so many interdependencies. So many companies owing something to other companies, and their management have gone on the run and are setting themselves up in Dubai or something like that, and are trying to resurrect themselves. We've got the ongoing lawsuit involving Celsius, which is the kind of mega popcorn, really, the various ways in which that develops. Celsius seems to be hoping to resurrect itself in some form, doing something rather different from what it was before. So before it was a lender, and quite a lot of its loans turned out to be unrecoverable, and it was lending out collateral, and so even the loans weren't even secured when they should have been, and there were all kinds of bad practices going on. There's some evidence that for part of its history it was a Ponzi scheme, so it was essentially paying its existing depositors with the assets of its new depositors. That's a Ponzi scheme. What it seems to be hoping to do is to somehow revitalize itself, either as a mining company or as a custodian. And it remains to be seen how viable that is. I have serious doubts about it myself. If I was the judge, I would have liquidated it already. But, I guess the judge is saying, well, we have to see whether they could put together a credible resurrection package and whether anybody will invest in that.
You've mentioned that you think more crypto companies will collapse. Is it because of this interconnectedness that you mentioned, Frances, that we're going to see more shoes that will drop? Or why do you think more crypto lenders and companies will collapse?
Interconnectedness is certainly part of it. We know from looking at other financial disasters in the past, obviously involving traditional finance, but you have to remember that traditional finance is an evolving thing, and aspects of traditional finance now that we take for granted were new in their time. But one enduring feature of financial crashes is that we get what we call exuberant growth, and then we get a crash. And the crash, during the period of exuberant growth, you get growth of companies that all connect with each other, and they connect with each other not only within a single country but globally. And then when the crash happens, it's like a house of cards falling, and that's really what's going on now. And I don't think we have seen the last of this particular house of cards falling, because I'm seeing strains in other parts. We've still got the ongoing liquidity drain in the fiat world, and stock market crashes there. And that will have knock-on effects into crypto. So I would expect there to be further crypto company failures and possibly even the failure of an exchange at some point. That's normally how these things play out, that it starts off with failures in what we might call shadow banking, the offshore, the periphery of the financial system, where it's a wild west and really quite badly regulated, and there are quite a few scammers, and you get rug pulls and Ponzi schemes and things like that, right? It starts off there, and as time goes on with an ongoing crisis, because of the interconnectedness, it comes in to what we might call the more regulated, the more accepted, the more established, maybe the more credible parts of the system. So, and if this plays out the same way, then that's what we would expect to see happen with crypto, that we've seen the low-hanging fruit, if you like, the shadow banks failing. Celsius is a shadow bank, correctly should be termed a shadow bank. What it was doing was banking in unregulated banking, and that is shadow banking. As time goes on, we might find that it comes into something much more regulated, much more credible, if you like, and see the failure of one of the big exchanges.
So talk to me a little bit more about the exchange's role, Francis. You and I have talked about this a little bit, but I noticed that not only the lending firms, but exchanges, a lot of different players in the crypto world relied on NFTs, digital assets called non-fungible tokens, NFTs, as collateral. So they would use this as collateral from investors, and then they would loan them a ton of money. Now, the NFT market has crashed. It's now at a trickle. And I think everyone's question is, how much value was there in NFTs in the first place? And should these firms, these shadow banks, but also these big established firms like exchanges, I think FTX and others also allowed NFTs to be used as collateral. Should they have used this as collateral in the first place? So talk to me about a little bit more about the direct role exchanges may have had in some of this chaos that we see going on today.
Yeah, I think the whole collateral question is fascinating, because it does remind me hugely of the way the financial system worked before the financial crisis in 2008, because so much of that was collateralized. So we had the creation of what we called safe assets, which were in this case backed by a real thing, a mortgage, packaged up into securities and sold on, and labeled as safe assets that could be used as collateral in lending, right? They turned out to be worthless. And with NFTs, I'm seeing something similar, that what we have underlying an NFT is a real thing, a piece of art of some kind. I might not think that an ape cartoon is worth very much, really. Yeah, but it is a real thing. It's a real piece of art. But the value that's ascribed to it and the way in which it's seen as a safe investment, I think, is entirely due to network effects, marketing, and hype. Frankly, I don't see a great deal of intrinsic value, as we might call it, fundamental value, in this market at all. And so it doesn't surprise me that the bottom has fallen out of it and it's gone right down to almost nothing. But the problem you've now got is where people have used it as collateral and lent against the collateral of NFTs, they've now got underwater loans. And the question now is whether those loans are going to be repaid. Because when your collateral fails, what you've got is unsecured loans. So you're entirely dependent on the ability and the willingness of your borrower actually to repay the loan. That's what we don't know at the moment, is whether what have suddenly become unsecured loans will be repaid. And if they aren't, then it depends whether the exchanges or whatever, or company or whatever it is that has lent the money, has the equity, has enough of its own funds to take the loss. Because if it doesn't, then it will fail.
And any idea how much of those loans are out there that are collateralized by NFTs? I don't know if anyone looked at that.
I don't know the volume that are collateralized by NFTs, but I mean, the whole of crypto lending is collateralized one way or another. So if it's not collateralized by an NFT, it's really collateralized by something else, and the bottom's been falling out of everything. So anybody with any crypto loans that are secured on crypto collateral at the moment is likely to be underwater just because the market has dropped so much. So we are dealing with an awful lot of unsecured loans, and it is not clear the extent to which those can be repaid. And if they can't, then we are going to see, I think, some corporate failures. The question is then, which companies exactly fail? And if we look back to what happened with banks, when banks failed, well, the reason they failed when the asset side of their balance sheets collapsed, basically, and they were left with this massive hole, so a huge pile of borrowings and no assets, right? What they had to do, whether they survived that, depended on how much equity they had, how much of their own funds. Now, the own funds part of a balance sheet is the gap between the value of your assets and the value of your liabilities. In a solvent company, the value of your assets should be more than the value of your liabilities, and the difference is your equity. You can quite see that if the value of your assets is falling, then that gap becomes smaller and smaller. If that gap is quite small anyway, then you can end up being underwater. And so it's possible that we might see some companies that haven't got enough equity to take the losses will end up insolvent.
It's a grim picture if you think about all the building blocks that could collapse here. Now, let's talk about stablecoins, which you've mentioned a bit in your previous comments. Stablecoins, by their definition, should be relatively stable, and a lot are pegged to the US dollar, which, as you mentioned, this is widely used in the crypto industry, the stablecoins. So in the wake of the meltdown of the Luna Terra ecosystem, Francis, how should crypto supporters, investors be thinking about stablecoins? Because now you have to question whether stablecoins are stable, right? You've seen a few other supposedly stablecoins kind of fall off its peg, then recover. So how should crypto supporters be thinking about stablecoins? And how about the regulators who have been thinking about regulating them for so long, but haven't done anything? What are your thoughts on both of those aspects?
Well, stablecoins are kind of used for two purposes. The first is that they're used as liquidity. So they're used as bridging currencies between crypto trades. Tether's used that way a lot, particularly on offshore exchanges. Yeah. So people don't hold it for long. So all you really want your stablecoin to do is just to hold its value long enough for you to trade it. You're not going to hold it for long periods of time. That's one kind of stablecoin. And there's a second kind of stablecoin, which is used as collateral. So USDC, for example, is used as collateral. And then you're dealing with something which needs to hold its value over a much longer period of time, because it is a safe asset. And you note at the moment I haven't specified a kind of stablecoin. I haven't distinguished yet between reserved stablecoins and algorithmic stablecoins. That second type of stablecoin that's used as collateral is usually a reserved stablecoin. So USDC, Gemini, Pax, those ones. And then on the other side, you've got the ones that you use as liquidity, like Tether, and you've got the algorithmic ones, which generally are now regarded as risky, with the exception of Maker, really, which seems to be being regarded as much safer and is itself seems to be used as collateral. So I think with stablecoins that the regulators have been very interested in them, and they've been coming up with proposals for regulating them, which are quite draconian, actually. The ones I've seen have drawn a sharp distinction between reserved stablecoins and other type and algorithmic ones, have treated all algorithmic stablecoins as intrinsically risky, and have then narrowed down within the reserved stablecoins between those that can be regarded as safe, or essentially fully reserved with safe fiat currency assets, so US treasuries, cash, that sort of thing, insured bank accounts, and those that are more diversified. So they are maybe backed by, might be fiat currency denominated assets, but riskier ones, such as corporate bonds or commercial paper, or are backed by crypto. So we're getting these three different classes, if you like, of stablecoin. The ones we've seen collapse and never recover have, I think, all been algorithmic ones. And it is a fact that in some algorithmic stablecoins, there does seem to be a fundamental flaw in the design, in that they suffer from what I would call a multiple equilibrium problem, that they're stable in one state of the world, but it is possible for them to shift to another state of the world in which they collapse to zero in a disorderly fashion. And it is actually possible for speculators to force that to happen. We saw that happen, I think, in 2021 with Iron Finance, and then we saw it again this year with UST Terra Luna. And it was essentially the same problem, that the whole design had that intrinsic vulnerability built into it, and somebody took advantage of that.
But you think regulators should move? Do you think regulators should move faster in regulating the stablecoin market? I mean, there's been a lot of talk for a long time and little concrete action. So what do you think should be happening, I guess, at this point?
Well, I'll come back to what you're going to use your stablecoin for. If you're going to use your stablecoin for fiat payments, in other words, if your stablecoins are going to form part of the main payment system of the world, then they have to be safe and they have to be fully convertible. And those will have to be regulated to the hilt. And my view, I've expressed this in writing, is that those should be issued by regulated banks. There is no particular reason why banks shouldn't issue a stablecoin. And they would need to be heavily regulated, because otherwise they're not safe. But if you're just going to use a stablecoin on offshore exchanges to trade crypto, I'm not convinced you need that level of speculation. Nobody's going to hold the stablecoin for very long. And to be honest, if people want to take the risk that it falls off its peg, caveat emptor applies. It's a marketplace, and crypto has always been a place where caveat emptor applies. And you would rather expect that on offshore exchanges in the far reaches of the crypto system, then that would continue to apply, and regulators really shouldn't get involved. So then there's a little bit of a grey area, I think, between those two extremes. And that's, I think, where we may need a different type of regulation. I talked about this a bit, along the lines of avoiding mis-selling, so that people know what they're getting into. Because I think one of the problems with retail investors is they often don't know what they're getting into, so they don't understand the products they're buying. One stablecoin looks much like another to them, and they believe the assurances that they're given, and then if the thing falls off its peg, then they get caught out. So we may need regulation regarding the information, the marketing information that is given to retail investors in particular, so that retail investors understand the products that they are getting in, that they're buying.
Right. And that's interesting. The marketing is a lot of it, because if you just listen to the term stablecoin, for someone who doesn't know about the industry, you would think inherently it is stable. Yeah. You wouldn't question it. So speaking about regulators, Frances, the SEC has suggested that it believes many tokens are actually securities. Gary Gensler has doubled down on the statement in recent days. And I wanted to ask you, now that the merge has happened, where do you have an opinion on where you think Ethereum falls in this spectrum? And one thing that I've been wondering is, with the crypto market crashing, does this give regulators just additional impetus to act, in the sense that they can say, look, so many investors are being hurt. We have to do something. We have to do it now. And is that why they're acting?
I think that actually the main reason why regulators need to get involved is the developing interconnectedness between the crypto world and mainstream finance, which is becoming dangerous. That has always been the point at which regulators and central banks would start to sit up and take interest. And we noticed, for example, that when Facebook was trying to create a stablecoin of its own and threatening to create something very, very big, we had coordinated action by governments to stamp on it.
Right.
And it actually died. It doesn't exist. It never saw the light of day. So there is that, and there's also the protection of investors thing. But I actually think the financial stability aspects are probably concentrating regulators' minds more, and are probably the reason why we are seeing much more regulatory impetus. Is we have got a lot more retail and traditional finance involvement now, and that carries the seeds of problems for the mainstream financial system, and they can't tolerate that. So when it comes down to securities, now, the US's securities laws are interesting. They are extraordinarily broad brush. Whereas kind of in other countries, they're constantly trying to play catch up on products, saying, oh, there's this product, we need to regulate it. There's that product, we need to regulate it. That's not the approach that the US's securities laws take. What the US's securities laws, which were devised in the Great Depression, they're very old laws. They date back to the 1930s. Basically say is that if it's not issued by a regulated bank, but it is a financial product, and that is that definition that everything hangs on, really, then it must be registered as a security. So the idea being that because historically we've always had regulated banks providing investment products, but then we've also had a range of other financial institutions providing investment products, and it was very easy for those investment products produced by non-banks to drop down the cracks and end up being unregulated and really quite scammy. And so the US's US's securities laws are designed to catch all of those, including things that haven't been invented yet. So the list is like, there's this huge list of products that would be classified as securities, dating back to the 1930s, and then it kind of says at the end, and anything else that we haven't thought of. So the argument from crypto companies that cryptocurrency shouldn't be treated as securities because they weren't invented, they weren't around in the 1930s, unfortunately fails on that one, because the legislation is specifically designed to catch things that hadn't been thought of in the 1930s. So the question really has boiled down to the type of cryptocurrency that it is. So Bitcoin has escaped being defined as a security, really because of its decentralized nature, and proof of work was the heart of that. Once, and Ethereum, while it was doing proof of work, while it was being mined in a decentralized way, also escaped being defined as a security, despite the fact that it was pre-mined. That was pushing it a bit, but now it's moved to proof of stake, which basically means the more, roughly speaking, the more Ethereum you hold, the more votes you have, approximately, then it is much more difficult for it to escape being caught by this general net of financial products that constitute the US securities laws. It'll be interesting to see what the SEC does, but from Gary Gensler's remarks, it does seem that he is minded to define it as a security.
And I think he made some remarks the day of the merge, September 15th as well. Just to remind our audience, Frances is based in the UK, but so she knows, but she obviously knows a lot about US laws as well. But she is based in the UK and an economist and analyst there. So one last question for you, Frances. You've said that crypto enthusiasts are beginning to realize that crypto has to develop a real world use or it will not survive the central bank liquidity drain. Talk to me about that for a moment, because I think some crypto supporters would say that crypto already has a real world use, whether it's smart contracts on the Ethereum chain, DAOs that fund political and social activism on Ethereum, or just the use of Bitcoin for transactions. So what do you mean by crypto developing a real world use, and what is the shift you see among crypto enthusiasts in terms of recognizing this?
When we see this kind of bear market where the values are crashing because essentially the value networks that have been propping this up, that have been creating the boom, are collapsing, then financial products kind of come back down to their essentials. They have to have something that makes people say, yeah, these have value in their own right, even when they're not being pumped up by network effects, and I can get in and make some money and then sell to someone else, and between us we can pump up the network, which is actually how crypto has acquired a lot of its value. It needs to be something to say, yeah, actually I can use that to, going back to Bitcoin's roots, to transfer money really quickly in a secure way across borders in a way that the financial system can't do, right? Which is still a USP for Bitcoin and for some other cryptocurrencies as well. And the same with things like smart contracts, and even with things like NFTs. NFTs for me always had the germ of a useful idea underneath them, particularly for digital artists, who can have problems marketing their work and so forth. It was a way of making their markets more liquid. And even for conventional arts, it's not by accident that people like Sotheby's and Christie's, the big auction houses, got involved quite early on, because they saw some use in NFTs in that marketplace of actually selling real art, right? And I think when the NFT market crashes down, what it needs to come back down to is that, what is this thing really useful for? Because in the end, that is what gives something its fundamental value. Network effects are built on top of that. But if something has no fundamental value, then it is worthless. And we have seen in the past how financial products that have been extremely expensive financial products can crash down to literally nothing. We have seen that happen. For crypto, it will come down to, what real world use does this thing have? Can it be used actually to make payments faster and more securely and more cheaply than the existing financial system? Can NFTs be a way of helping digital artists to market their work more effectively and keep a better track of ownership? Things like that, I think, are really what the crypto world needs to be working on now. Smart contracts as well. Yeah, there are clearly uses for smart contracts. I think we need to understand their limitations, and we need to understand how they need to be embedded in terrestrial law. When they started, we had this romantic idea that smart contracts would replace courts. I think we now know they don't, because smart contracts themselves can be flawed, and they can be ambiguous, and they don't account for every use case. So there'll always be this need for what we might call exception handling. And, people will continue to file lawsuits about things involving smart contracts. But I think we need a better legal framework, more to be clearer where the boundaries lie between the smart contract and the courts, yeah, and create a proper legal framework so that within their limited boundaries, smart contracts actually are law, which at the moment technically they aren't. So things like that need to be worked on, and I know that the crypto world is working on this, but I would rather see effort going into sorting all of that out than trying to build up the hype networks again. And yeah, we can get rich quick, and here's some clever marketing and a slick website, and we'll draw in some people and pump up the prices. For me, that's not actually a very good use case. And while we've got this fiat currency liquidity drain going on, it's not sustainable, because in the end you can only realize any values you've created by pumping up prices if you can actually get it out into fiat currency. If there's not very much fiat currency around, how are you going to do that?
That's a good question. Frances, thank you so much for being here with us today. You can follow Frances Coppola on Twitter. She also has a blog, again, coppolacomment.com. Thank you again, Frances.
Pleasure.